Hello everyone and welcome to Financial Accounting. In today's video we're going to go over Chapter 9, which is about long-term assets. And long-term assets consist of two things. Fixed assets, sometimes we call it plant assets or property, plant and equipment, and the other part is intangible assets. So we'll get to talk more about fixed assets at the very beginning, and then in the second part we're going to focus more on the intangible assets. One of the interesting things in long-term assets is how we record depreciation, or for intangible assets we're going to call it like amortization. And we're also going to talk about natural resources where they get depleted. So the process of depreciation, amortization, and depletion is really interesting, and we'll talk about that shortly. So let's start with the nature of fixed assets. What are fixed assets? These are long-term or relatively permanent assets such as equipment, machinery, buildings and land. So things like vehicles, trucks, computers, furniture, all of these would go under equipment, machinery, and then for buildings, of course, we all know, like a warehouse or something like that, and land is land. One thing I want you to remember about land, it has a specific nature compared to all other fixed assets, which is that it doesn't lose value over time. Compared to other fixed assets like equipment, machinery, and building, they usually lose value over time because of obsolescence, or they get old and like wear and tear and things like that. So other descriptive titles for fixed assets, as I mentioned before, are plant assets, and sometimes we call them property, plant, and equipment. Fixed assets have the following characteristics. They exist physically and therefore are tangible assets. So in other words, we can't touch them, and we really want to focus on this because later on when we'll talk about intangible assets, they have slightly different nature. They're owned and used by the company in its normal operations, so it's not something we're buying with the intention of reselling. We are buying with the intention of using in the business. They are not offered for sale as part of normal operations. So that's exactly what we mean by they're used for normal operations. So they're not part of our inventory. So we don't buy them with the intention of selling them. Also, fixed assets are critical to the success of many businesses. And this is why businesses taking decisions of buying their fixed assets is very important, because if they don't do the smart job of selecting the right asset, might affect how successful the business is. So how we classify the cost for fixed assets. So a cost that has been incurred may be classified as fixed assets. It could be also classified as an investment or an expense. And we have to decide where this would go. Is it a fixed asset? Is it an investment? Or is it an expense? So items that are classified and recorded as fixed assets include things like land, buildings, or equipment. Such assets normally last more than a year and are used in the normal operations of the business. So standby equipment for use during peak periods or when other equipment breaks down is still classified as a fixed asset, even though it's not used very often. And of course, this is not very typical, but some businesses, this is very important because they cannot afford if an equipment is not working. So they need to have a backup. So that's why we call it standby equipment. And these are still part of the fixed assets. So fixed assets that have been abandoned or are no longer used in operations are not classified as fixed assets any longer. So once we retire a fixed asset, we don't put it as part of the fixed assets any longer. So let's see this kind of simplify flow chart or decision tree, if you can call it. And the first step you have to ask yourself, is the purchased item long-lived? If it's not something that's going to stay with the business for a long time, we expense it right away. So if the answer is no, we just expense it. But if the answer is yes, this is not it. We have to ask another question. Is the asset used in normal operations? So if it's used in normal operations, then it's classified as a fixed asset. If it's not part of the operations, then it's an investment. So let's say Walmart, they bought a building, but they're not using it in their operations. They're just renting it out for other companies. So that's an investment. Or they're holding it, they bought a land and they're holding it for speculations. They just want to see like if the value of the land is going to go up. That's an investment. It's not used as part of the operations. But if they bought a land next to one of their warehouses and they use it as a parking lot for their warehouse, that's part of their fixed assets. So what should be included in the cost of fixed assets? So in addition to the purchase price, the cost of acquiring fixed assets include all amounts spent getting the assets in place and ready for use. Only costs necessary for preparing the fixed assets for use are included as cost of assets. What about unnecessary costs? Unnecessary costs that do not increase the asset's usefulness are recorded as an expense. So just to give you an example, like here we have a few examples like vandalism, mistakes in installments. Like the cost of installment normally would be part of the fixed assets. So let's say we bought an equipment and it has to be installed in a specific place with some kind of specifications, and then the installer made some mistakes, and now we have to correct these mistakes. The cost of the correction is not part of the cost of the fixed asset. That should be expensed. Also, uninsured theft, damages during unpackaging or unpacking and installing, fines for not obtaining proper permits from government agencies. All of these expenditures or costs has to be expensed. They're not going to be part of the cost of the asset. Or in other words, we do not capitalize it. So when we say capitalize it, we mean to add it to the cost of the fixed asset. When we say expense it, it goes to the income statement as an expense that would match our revenues for the period. So here let's see some examples of related costs for buildings, machinery, equipment, and land. So for buildings, things like architect fees, engineer fees, insurance costs incurred during construction. Insurance costs after construction, that's an expense. But insurance costs during construction, that's part of the cost of the asset or the building. Interest on money borrowed to finance construction. Again, until construction is completed. Sales tax. So when you buy something and you incur some sales tax, the sales tax is part of the cost of that fixed asset. Repairs. When purchasing an existing building. So let's say we bought a building, we know it has some issues, and we're going to fix it. These kind of repairs done are considered to be part of the cost of the building. Not regular maintenance. These are expenses. Reconditioning. Purchase of existing building again, and we're reconditioning. Modifying for use. So we bought let's say a warehouse, and we're going to convert it into some kind of form of construction place. Modification for use, as I mentioned. Permits from government agencies. Again, all of these are considered to be part of the cost of the fixed asset. How about machinery and equipment? Same thing. Sales taxes, freight, which is the cost of shipping, installation, repairs if we purchase a used equipment, reconditioning, again if we purchase a used equipment, insurance while it's in transit. Again, once you receive the equipment or the machinery and start using it, any kind of insurance you have while using it, that's just regular expense. Assembly, modification for use, testing for use, permits from government agencies. All of these are additional costs that can be added to the cost of the machinery. Land would include the purchase price, would include the sales tax, would include permits from government agencies, broker's commission, title fees, surveying fees, delinquent real estate taxes. Sometimes you buy land where it has property tax or real tax that hasn't been paid with the previous owner, and you accepted to take over this kind of delayed taxes. So in this case it would be part of the cost of land. Demolishing or removing unwanted building less any salvage. So let's say I bought a building for $100,000. It has, land for $100,000. It has a building on it, and we don't need this building, and we expect that we have to remove this building, and the cost of removing the building is $10,000. So now the cost of the building is the 100 plus the cost. The cost of the land is 100,000 plus the cost of removing the old building, which is $10,000. That would make it $110,000. But let's say the old building, when we removed it, it has some kind of things that we were able to sell. So in this case, we got like $1,000 back. So in this case, it would be the 100,000 plus 10,000 minus the salvage, which is 1,000. So it would be 1,009. Also, the cost of grading and leveling the land is part of the cost of the land. How about something called land improvements? So things like land and shrubs, fences, outdoor lighting, paved parking areas or walkways. Again, these are part of the cost of land improvements. Usually it's a separate category of a fixed asset. One thing you have to keep in mind, land improvements are subject to depreciation. Same thing for building and machinery, but land itself is not subject to depreciation. And we'll get to talk about that more when we start going over depreciation. So let's see an example. Assume Kimball Incorporated purchased equipment for $12,000. The freight cost of $600 were incurred to transport the equipment to the installation site. On-site, installation costs of $1,500 were incurred, including $500 due to an error installation. So we actually paid $1,500, but the good part of the $1,500 was only $1,000. $500 were paid extra because of an error. So the journal entry to record the equipment would be debiting equipment. As we all know, equipment is an asset, it's increasing, and we credit cash. And now we need to think, what did we incur? Actually, what should be part of the equipment? It's the purchase price, $12,000, the freight, of course, so we have the $600, and the $1,500, but we have to remove the $500 because these $500 were due to an error installation. So that should be expensed right away. So we will have installation expense and cash and another journal entry for the $500. But here we're just going to exclude the $500 out of the $1,500, and the total value is $13,600. So a company may incur costs associated with construction or constructing a fixed asset such as a new building. The direct cost incurred in the construction, such as labor and materials, should be capitalized. And by capitalized, I mean it's part of the fixed assets cost. So should be capitalized as a debit to an account entitled construction in progress. Sometimes they call it construction in process. It's the same thing, tomato, tomato. So some accountants, they like to use construction in progress or construction in process. So when we are still building this new building, or we're in the process of the construction, we don't use the building account right away. We use the construction in progress until it's completed. So when the construction is complete, the costs are reclassified by crediting the construction in progress and debiting the proper fixed asset accounts such as building. Now let's talk about something that's also related to fixed asset, but it's not when you're buying a fixed asset, you're leasing it. And sometimes a company would lease a fixed asset for a long period of time. So a lease is a contract for the use of an asset for a period of time. Leases are often used in businesses, for example, automobiles, and a lot of people, they lease their cars instead of buying them. Same thing for computers, medical equipment, buildings, and airplanes, and these are some few examples of fixed assets that are often leased. I know for universities, for example, photocopier machines, these are typically leased, things like that. So the two parties to a lease contract are the lessor and the lessee. So the lessor is the party who owns the asset, which is typically the company or the dealer that sells this kind of fixed asset. And the lessee is the party to whom the right to use the asset are granted by the lessor. So technically the lessor is the one who owns the asset, but they give the right of using the asset to the lessee. So under a lease contract, the lessee pays rent on a periodic basis for the lease term. So what are the advantages of leasing an asset? Basically is that the lessee has access to an asset without having to spend funds or obtaining financing to buy the asset. So I'm just renting it. I'm using it for a specific period of time, and then I'm giving it up. So expenses such as maintenance and repairs costs may be the responsibility of the lessor, and the risk of incurring additional costs because the asset becomes obsolete before the end of its useful life can be mitigated by leasing an asset. So many businesses, they don't want to go through the headache of owning the asset and repairing it and worrying that if it's getting old or not. Then they just lease it for like 2 or 3 years. Once it's over, they give it back to the lessor and lease a new one and move on. So the Financial Accounting Standard Board, known as FASB, and the International Accounting Standards Board, which is also known as ISB, recently completed a project to merge US and international standards on leasing. So now we have very few differences between both. The new FASB standards distinguish between finance lease and operating leases. So under both finance and operating leases, the lessee records an asset and liability similar to having purchased the asset. So the amount of depreciation expense and interest expense would differ from each type of lease. So for short-term leases, which we call them the operating leases, the lease term is 12 months or less. The lessee records lease payments by debiting rent expense and crediting cash. But for the other one, we're going to have a different treatment. But again, this is the only thing I want you to know. I don't want you to go into more details at this stage. This is what I care about: capital lease, or finance lease and operating lease. I don't want you to go more into the details of how we do the accounting for it. Now let's talk about an important thing that relates to fixed assets, which is depreciation. Depreciation is when an asset loses value over time. Why an asset will lose value? It's because, again, things get obsolete. They're not as productive as they are when they're compared to when they are new. So one thing I want you to remember is that, basically, depreciation is that you take the cost of the fixed asset and you allocate it over a period of time where this asset is going to be productive. The main idea of calculating depreciation, recording depreciation expense, is to satisfy the matching principle. You want to make sure that the cost of the asset that you incurred is spread over its useful life, and remember, this asset generates revenue, so we want to make sure that we match the expense of the asset to the revenue that is generated during the period where this asset is productive. So over time, fixed assets, with the exception of land, and remember that, with the exception of land, lose their ability to provide services. So land is an exception. Land is one of those things that they don't get obsolete, they don't get old or anything like that. So the cost of fixed assets such as equipment and buildings should be recorded as an expense over their useful lives. Recording the cost of fixed assets as an expense is called depreciation. And we've seen one of those typical depreciation, or what we call it, adjusting entry related to depreciation, in Chapter 3. So we're just going to repeat that in this chapter, and we're going to go in more details of how we calculate the depreciation expense. So because land has an unlimited life, it's not depreciated, and it's not depreciable. So remember that. I think that's one of the important things and benefits of land. So depreciation can be caused by physical or functional factors. Physical depreciation factors include wear and tear during use from exposure to weather. And again, there are so many examples about that, like a truck, for example, or something would get used and consumed, and it's exposed to weather and gets old. And sometimes we can also think about buildings, the same thing. Function depreciation factors include obsolescence and changes in customer needs that cause the asset to no longer provide service for which it was intended. So for example, a computer. A computer might be still running, but it's getting obsolete because the technology has advanced and the old computer is not very productive as a new computer. So two common misunderstandings that exist about depreciation, I want you to remember that, is that depreciation does not measure a decline in the market value of a fixed asset. We're not trying to adjust the value of the fixed asset to the market. That's not the intention of depreciation. Instead, depreciation is the allocation of the fixed asset's cost to expense over the asset's useful life. That's the main purpose of depreciation. But it's not to adjust the value of the asset or the fixed asset to the market value. The other thing is the book value of a fixed asset, which is the cost less the accumulated depreciation, usually does not agree with the asset's market value. And as accountants, like an accountant would never try to adjust the book value of the fixed asset to the market value. That's never the intention of the accountant whenever they are calculating depreciation expense. So depreciation also does not provide cash to replace fixed assets as they wear out. Many people think, oh, depreciation is like setting aside some cash so we can use it to replace the asset later on. That's not true. That's far from true. So what are the factors in computing depreciation expense? There are three factors that determine the depreciation expense of a fixed asset. The most important is the initial cost, like how much did we incur for that asset. The second thing is its expected useful life. And the other one, it's estimated residual value. Sometimes we call it the salvage value or the scrap value. They're all the same thing. So residual value, scrap value. This is like how much you're going to expect to get from selling the asset after its useful life. So the initial cost of a fixed asset is the purchase price of the asset plus all costs to obtain this asset and make it ready for use. The expected useful life of a fixed asset is the estimated length of time the asset will be used in normal operations. It is estimated at the time the asset is placed into service. Keep in mind, the initial cost is only the factual value, but the expected useful life and the estimated residual value, these are estimates. This is something that we estimate how long we can use this asset and how much we can sell it for. So the residual value of a fixed asset, again, it's the estimated value of the asset at the end of the useful life. It is estimated at the time the asset is placed into service. Residual value is sometimes referred to as scrap value, salvage value, and again, in a few cases you might see it referred to as trade-in value. The asset's depreciable cost is the difference between the fixed asset's initial cost and its residual value. So let's say I bought a truck, I paid for it $20,000 and I expect to sell it for $5,000 after 5 years. So the depreciable cost is the $20,000 minus the $5,000, which is the $15,000. So $20,000, that's the initial cost, which is how much I paid for that truck, minus the residual value, which is the $5,000, would give us what we call a depreciable cost, which is the cost that we're going to allocate over the life of that asset. So this is the asset's cost that is allocated over its useful life as depreciation expense. So let's see a simple example here. Assume Expe company purchased a new forklift on January 1st as follows. It has an initial cost of $24,000, the expected useful life is 5 years, and its estimated residual value after 5 years is only $2,000. So in this case, the depreciable cost is going to be $24,000 minus the $2,000, which is $22,000. And this is what we see here. So $24,000 initial cost, residual value is $2,000, and depreciable cost is $22,000. So the $22,000 is going to be allocated over these 5 years. And we'll see like how we're going to allocate that. So, but the thing is, the $22,000 can be like allocated evenly over the 5 years, and sometimes we take other consideration. We'll talk about that in the next video. So the three depreciation methods used most often are the straight line depreciation, something called units of activity depreciation, and the third one is double declining balance depreciation, which is sometimes referred to as an accelerated depreciation method. It's not necessary for a company to use only one method of computing depreciation for all of its fixed assets. They can mix and match, but sometimes consistency is needed for depreciation methods among similar assets. So, for example, computers are all depreciated using the double declining balance method, but buildings are depreciated using the straight line depreciation. But again, you can use any of these depreciation methods. So let me stop here, and in the next video we're going to talk more about these depreciation methods.